All right, we have 30 minutes until the start of trading with stocks 2% from their all-time high. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, retail sales data suggests tariffs deterred consumers from spending. We'll talk about that. Plus, President Trump unexpectedly splits from the G7 summit earlier to deal with the Israel-Iran conflict. And JPMorgan is raising the fee for its Sapphire Reserve credit card to nearly $800 as the credit card wars heat up. Katie, what are you watching?
I'm keeping my eye on energy stocks right now. We're closely monitoring what's going on in the Middle East, and investors are too, assessing those risks of the conflict. Iran's oil output hit a 7-year high last month in another example of the global implications of these attacks. You keep an eye on some of these names, not moving too much, but the color is green, Matt.
Yeah, we got oil back above $70 here in the U.S., crude at 74. Keep an eye also on defense stocks after President Trump said he wants a real end to the nuclear dispute with Iran, not a ceasefire. You can see Halliburton is gaining, Lockheed is up, and Baker Hughes. Like Katie said, not huge gains, but the color here is green. So directionally, we're going the opposite way right now of the benchmarks. Katie?
We also have our eyes on Canada, and here's the post that President Donald Trump sent as he left the G7 summit early. Iran should have signed the deal I told them to sign. Simply stated, Iran cannot have a nuclear weapon. I said it over and over again. Everyone should immediately evacuate Tehran. He then said this aboard Air Force One.
I've been negotiating. I told them to do the deal. They should have done the deal. The cities have been blown to pieces. We've lost a lot of people. They should have done the deal. I told them do the deal. So I don't know. I'm not too much in a mood to negotiate.
Bloomberg Politics correspondent David Gura joins us now. He is at the G7 site in Canada that President Trump has departed. What are the rest of the leaders' reactions to, the President of the United States up and leaving the G7, and also his advisory to the people of Tehran to leave now?
Yeah, so a lot of people here have memories of what happened in 2018 when the president left in a peak. He ripped up the communique and got on the plane and began tweeting about Justin Trudeau, who was then the prime minister. This was not that, and there were some comments, some questions and comments at that family photograph that took place yesterday before the president left. And it seemed like a lot of those world leaders understood or sympathized with President Trump's decision to leave. Certainly Mark Carney, the Prime Minister of Canada, did, acknowledging the fact that there is a lot happening in the world. The president would be more comfortable back in Washington, D.C. So again, the circumstances are different than 2018, but it did send a shock through the summit site. And you bring up that post about evacuating Tehran. I think that had an even larger effect because people saw that right after the president delivered comments with the Prime Minister of the United Kingdom on Iran and wondered, what is this? What's motivating this? What's he talking about? And I think we still have little explanation for what the president posted on Truth Social before he made his way to that family photo and to dinner and then ultimately back to Washington. So the question now facing the president, facing all of us, is sort of what are the next steps here, Matt? And is that more diplomatic engagement? Is he going to send a Vice President Vance to the Middle East? Is he going to send his trusted envoy, Steve Witkoff, to engage in negotiations with the Iranians? Is he trying to get this kind of permanent ceasefire or end to this conflict in place as he's talked about? Or is it a sign that perhaps he's looking at more military options and kind of ratchet that up in a way that he's been opposed to over these last few weeks?
Yes, certainly Trump left a lot of questions behind. And David, I want to talk about what happens now at the G7. You obviously still are in front of a beautiful mountain. You think about one of the main topics of this summit was trade policy. And without President Trump there, what does that conversation look like?
Yeah, he is, of course, the principal on that front, and so many world leaders came here expecting that they would have time with him on the sidelines of the summit to talk about trade policy and tariffs, and that did happen to an extent. We saw the Japanese prime minister securing a meeting that he had really been angling for many weeks, and the outcome of that wasn't what he wanted. It's just a continuation of talks. But as I mentioned, the president did stand side by side with Keir Starmer of the United Kingdom, held up this document until the wind blew it out of their hands onto the ground, and they had to pick it up. But effectively, they were codifying this agreement they announced a few weeks ago, this kind of broad strokes trade deal. But just looking back to the run-up to this summit, before the conflict in the Middle East erupted and intensified, it was the expectation that this was going to be the issue that was going to dominate the unofficial agenda here at the G7. This is what President Trump is going to be occupied with. He brought pretty much his entire economic team with him on Air Force One, including the Treasury Secretary and the U.S. Trade Representative. Now these leaders will talk among themselves, I suppose, about the way that the geo-economy has changed. And there are some leaders who arrived late last night as the president was leaving. We have Narendra Modi of India, who's now here, the Prime Minister of India, and President Vladimir Zelensky of Ukraine is here as well. So there's no matter of other topics for them to discuss, but certainly not having the U.S. here is a big deficit for all these participants.
All right, David, great reporting as always. That is Bloomberg's David Gura joining us from the G7 summit. Let's pivot now to the economic front in the U.S. because retail sales in May saw the largest decline since the start of the year, falling more than expected. Let's break down this data with Bloomberg's Michael McKee. He is our international economics and policy correspondent. So the headline here, Mike, was quite ugly. We're talking about a decline of 0.9%. Where was the weakness really apparent?
And don't forget that the headline was revised down last month by 0.1%, so a total of negative 10%. But that is just the headline, Katie, as you were suggesting. And if you look under the hood, it isn't quite as bad. While we did see a decline in the headline number, we saw a rise in the control group, which takes out the categories like automobiles, gasoline, and building materials, because they're in other parts of GDP, and this is what goes into GDP as far as retail sales. That was up 0.4, the control group. April was revised to a negative 0.1%. It had been negative 2. So overall, a better report on American spending. Biggest moves were in gasoline, autos, and building materials. They dropped a lot during the month, and that was expected, especially with gasoline prices falling and automobiles being pulled forward purchases in January, February, March ahead of the tariffs. We also got some import price data today. Didn't move the needle very much. Import prices were flat. Take out petroleum. They were up just 0.2%. And we're not really going to see a lot of tariff impact in those numbers. So it leaves the economy in reasonably good shape at the moment through about a month or two of the second quarter. We're running at a much higher GDP level, 3.8%, than we were in the first quarter, which saw a contraction, at least according to the Atlanta Fed. They get a new update out today incorporating these retail sales numbers, and we'll see how good that actually turns out to be.
Mike, I just got to ask quickly about the Fed tomorrow. Does Jay Powell care that oil prices have gone up recently?
In a long-term sense, yes, because it depends on, it depends on how long they stay up. But it could mean that we get some inflation in the economy down the road in secondary places, sort of like chemicals and plastics and things like that. But it isn't going to change the Fed's view of the overall economy at this point.
All right, Mike, thanks very much. Bloomberg's Michael McKee, our international politics and economics editor. Let's stick with spending right now because JPMorgan is boosting its Sapphire Reserve fee to a whopping $795 per year, but adding many more perks to try and justify that price hike. Sonali Basak is our lead financial correspondent, joins us here at the desk. And Sonali, this is a big change, both in terms of the price, right? It's now more expensive than the Amex Platinum, but you could be cashing out benefits of $1,600, $1,700, $2,000. That depends on how much you spend.
Yeah, it's really the first time we've seen this price hike since 2020. It used to be $550 a year, now $795, as you're saying. That is $100 more than Amex. Bloomberg did the math on this. You can get in perks $2,700 a year back. So if you're using all the perks, it is well worth your money. But again, it is now the most expensive card on the market, as broken this morning by our own Bloomberg's Hannah Levitt. Remember, a lot of money comes into JPMorgan through this card business. In fact, Marianne Lake, about a month ago, said half of Chase's new customers come through this card business. JPMorgan invested a lot in different things to make it exciting for customers. You might remember when they bought the Infatuation. I don't know if you've been on the website before to look for new places to eat.
The Infatuation is like a travel site or
it's a restaurant site.
Oh,
and so
okay.
why would JPMorgan be buying a restaurant site, right? And the reason is for perks like this. You get a lot of money back in different ways, too. For example, you get $250 for Apple TV, Apple Music, but you get another $300 for StubHub and DoorDash. So add it all together, and yes, you get your $2,700 back.
Now, you have to spend well over $75,000 a year to get to that, right? But even if you don't, you get, I think, a $300 dining credit, a $500 hotel credit at their elite hotels, right? A $300, as you mentioned, StubHub, $250 for Apple Music, Apple TV. You can get $1,650, I think, without spending anything.
There you go. So there's plenty of perks. How does this sort of reset the competitive environment?
Well, remember, just a day ago, Amex was saying that they're going to make its largest investment ever in the Platinum Card. And just from a macro perspective, guys, it's really interesting to watch this. You've seen Amex shares over the last 2 years just soar. They're actually down on the year. And so you see that top tier getting more and more competitive, even though it's kind of a signal here that bifurcation in the economy. You were just talking about retail sales. Overall, there's weakness. But when you come to the highest end consumer, there is a lot of desire to squeak that extra dollar out.
All right. Thank you very much. Sonali Basak there on the new JPMorgan Sapphire credit card offering. The credit card wars kick off. Remember, after yesterday, Amex said they're going to boost spending to levels like we've never seen before.
Yeah,
just huge levels of spending.
Huge levels. Not much reaction in the shares, but let's get to the broader market.
I think it's not really about the shares, right? Because our viewers use these credit cards.
For sure.
So while they're on the Bloomberg terminal, they're reading the stories about work, but then they see something that affects their wallet and they're reading those stories too. So, you know, it's not all about the market moves for Bloomberg clients.
Okay, well, given that we're 20 minutes away from the opening bell, let's get a check on futures right now. You can see the S&P 500 down by about 0.5% right now. Similar moves across benchmarks. The Russell 2000 down a little bit more. We have some interesting movers under the surface, though. We have to talk about solar stocks, such as First Solar plunging as the Senate version of the tax bill eliminates credits earlier than anticipated. I really want to get to JetBlue, though. This news breaking just in the last couple of minutes, reporting coming from CNBC that JetBlue is assessing the size and scope of its leadership team. The CEO saying that the path to profitability is going to take longer than expected. Plans to cut flights, pause retrofits, and park some jets. You add it up together, you can see that JetBlue down nearly 5% right now. This is a stock that's down nearly 60% over the past 5 years.
Yeah, it's been absolutely crushed, and they're seeing a slowdown in travel demand. On the one hand, I would think the problems that JetBlue has are JetBlue problems. On the other hand, this is an industry where customers just pick whatever's cheapest.
That's true.
So if demand is dropping for JetBlue, demand is likely dropping for most of the segment.
That's true, and we're going to spend plenty of time on airlines in this hour, but you can see the JetBlue shares down about 5% pre-market, adding to an already pretty ugly 5-year chart. Coming up, Meta pushes further into AI with a new tool to generate ads. We'll have more details next. This is Open Interest.
Now let's get to high interest. Look at what's making headlines around the world. Senate Republicans are proposing a tax cut plan that would reduce taxes for households and businesses, but also cut Medicaid benefits. The plan would preserve President Trump's first-term tax cuts, create new breaks, and repeal some clean energy tax credits. But it faces opposition from some Republicans over those Medicaid cuts. Republicans hope to pass the bill by July 4th, but that could be pretty tough. SoftBank is raising around $4.8 billion through a sale of T-Mobile shares. The sale will help fund SoftBank's plans to invest tens or hundreds of billions of dollars into AI, and they may even sell more T-Mobile shares or other stuff that they have to do that. And Kraft Heinz will remove synthetic food dyes from all of its U.S. products by the end of 2027. This move eliminates ingredients like Red 40 and Yellow 5 from Jell-O, Kool-Aid, and some Lunchables products, which, if you're eating those, how healthy are you really? Anyway, Kraft Heinz is now the largest U.S. packaged food company to fully commit to eliminating the artificial colorants regulated by the Food and Drug Administration, Katie.
All right, well, let's move on swiftly here and talk about Meta. It's a conversation we've been having for the past couple days. Meta continuing to bolster its efforts to capitalize on the advent of generative AI. The owner of Facebook and Instagram today announced an updated image-to-video ad tool, which lets marketers use AI to turn product pictures into multi-scene video ads. For more, Bloomberg Tech co-host Caroline Hyde joins us now. So this is interesting. I mean, you know, for so long we've been focused on the picks and shovels, but now it really feels like you're starting to see some of the use cases come out. And in Meta's case, ways to monetize.
And ways to monetize to the core buyer of their ad products, which are small and medium-sized businesses. These people don't have really expensive ad campaigns going on with WPP and some of the other juggernauts. They're kind of making them themselves. This is giving you the generative AI tools to take a picture of the coffee that you're selling. Mm-hmm. But then suddenly, not only can you change the background, you can change the way in which the coffee looks. You can put it in different scenarios. Then you can suddenly create an entire video out of it. This is going to make our AI content experience probably become a bit exhausting. We're not going to know what's real and what's not from a product placement perspective, but really it gives the tools to the small and medium-sized enterprises. It's interesting, if you go into some of the marketing tools that overall Meta is using to communicate this, over in Cannes, they're all having a lovely time in the sunshine, but they're trying to tell the advertising community, we've got you. This is going to give you yet more creativity. This is going to have you even more work. Because I'd imagine if I was a creative at an ad agency right now, I'd be kind of freaking out. But they're kind of trying to make the case that this is going to be additive rather than taking away.
I mean, I already have no idea what's real or AI generated on Facebook, on Instagram.
The internet's a dangerous place for you.
I don't think anyone does. But I feel like on WhatsApp, I can trust that the messages I'm getting are from you or from Katie, right? How are they going to do advertising on WhatsApp?
If you're going into updates. So it's not going to suddenly come into our little private chats that we have on our WhatsApp at the moment, Matt. It's actually going to be going into updates if you click in there, and that's where you're already perhaps... I mean, Matt, you like certain soccer teams. I know you're a big petrol head. There are already groups, business community groups, that you can tap into and have conversations in updates that are all around the interest that you have. That's where Ferrari might pepper in the odd ad. That's where suddenly you get more personalized content coming your way. And indeed, you'll start to perhaps see businesses want to give a subscription. Maybe they'll take a cut of that in the future. So WhatsApp, I agree. What's going on in TikTok's even weirder in many ways and more dystopian, because they're giving you AI-generated avatars, people. Already they're starting to see that these video ads are being put forward by an influencer that you don't know and recognize, but a totally created one. So TikTok's taking on that generative AI video, text-to-video generation even further. So this is a whole new era of trying to work out what's real, what's not, and perhaps the odd influencer is perhaps not doing as well as they once did.
You know, I just bought a pair of fake jeans on TikTok. But
fake jeans?
Yeah,
sorry.
They're actually leggings.
Those are called jeggings.
I don't want to call them jeggings.
I thought you meant fake as in they weren't going to arrive. No, there was a real purchase.
Mean, they haven't arrived yet, so watch this space. I'll keep you all updated. Our thanks to Bloomberg Tech co-host Caroline Hyde. Shall we talk about some more movers on our radar?
Why don't we? As we're approaching, I mean, as you mentioned, we're approaching the bell. So
we do this every day. We count down to the opening bell, and I want to talk about Walmart. It's down a little bit, but it's nursing its longest losing streak since 2011 with 9 straight down days. So if the color is red, that means we're still there. AMD.
9 days?
Yeah.
I don't remember Walmart being down 9 days.
Okay, this is a Ferris Bueller reference. I won't be fooled again. Let's talk about AMD. Continues to climb. It spiked 9% yesterday. Now it's up another 2% pre-market. We'll see if it can continue its hot hand. And then JetBlue, actually, so it's down 2% right now. It was down closer to 5% a couple minutes ago after CNBC broke the news that it's planning cost cuts with a break even for 2025. Unlikely, according to an internal memo. Some of those losses coming back, but the direction of travel, not good.
Not great for JetBlue and maybe for global travel. Coming up, Meredith Whitney is going to share her proprietary research on the economy and consumers following today's weak retail sales print. You don't want to miss it. This is Open Interest.
Welcome back to Open Interest. We learned at 8:30 this morning that retail sales fell for a second month in May as anxiety over tariffs and finances prompted consumers to pull back on spending. Let's discuss the state of the economy and the consumer now with Meredith Whitney. She is Whitney Advisory Group CEO. Meredith, great to have you in person.
Thanks for having me here.
So we got the retail sales, the headline figure, really ugly, a real miss there. I know that you track the flow of money in this economy at the consumer level very closely. Was this a surprise to you?
It was, because I look at the data that I look at monthly comes from Fiserv. It's called Spend Trend, and it's real credit card and debit card data. And it showed surprisingly strong growth year on year and month on month, and I was surprised by it. So I'm less surprised by the data today. I was more surprised by the data that came out last week. I can tell you what I am hearing from a corporate level, which is juxtaposed to what they said on the earnings call. Every retailer has increased prices across the board, so they can't be accused of, when tariffs are finalized, oh, you raised tariffs on this item because the equivalent tariff went up by this much. And so I think the retailers are protecting themselves. The damage is done. So I think the prices are going up, and consumers will decide where and what to spend on.
So what, I mean, I feel like we've known each other forever. We've been through a few recessions together. We went through the great financial crisis together. At what point can you count the U.S. consumer out? Because it's so, the U.S. consumer is so unstoppable, right?
Yeah, well, the high-end U.S. consumer is unstoppable. 52% of households are stoppable. And, this is a small market, but, the buy now, pay later is up, and people are opting more to use the buy now, pay later. Well, because everybody wants a lower payment when you buy something. So I don't know whether that's a sign of stress or not, but I think this summer is going to be critical because you're going to see higher prices, and I think you're going to see higher employment, and that is going to challenge the U.S.
Higher
consumer.
unemployment.
Higher unemployment.
Yeah.
Thank you. And that's going to challenge the U.S. consumer.
All right, Meredith, we are just getting started. Meredith Whitney is sticking with us through the opening bell, and here's the setup as we count down to the bells. The S&P 500, the Nasdaq 100, the Russell 2000, all lower this morning after a big day yesterday. We'll take you through all the action coming up next. This is Open Interest.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. 20 seconds until the bell, and we have red arrows here across the board. S&P futures down 0.4%. NASDAQ futures off a little more. But I will say that we are only 2% away from an all-time high. So we're not at low levels, and we've been sort of bouncing up and down the past few days on the news out of Israel and Iran, as well as one big, beautiful bill. You see the New York Stock Exchange, you hear the bell in the New York Stock Exchange and see the guys from Virtu ringing it there. That stock has done pretty well. It's up 118% over the last 5 years. I think 164% over the last 10 years. So you've made money. You've more than doubled your money. This is even better, though. Casella is a stock that is up, I think, almost tripled in the last 5 years, but 2,000% in the last decade. So these guys are notably happier because they've made so much more money. That is not the case for JetBlue shareholders today, Katie, after the CEO was on CNBC and said they're really paring back.
Well, let's talk about it a little bit. JetBlue shares down about 2% at the opening bell on news that it's looking at new cost cuts. Now, that might include cutting flights and pausing retrofits. It's also restructuring some leadership roles. Shares down about 2%. Like I said, it was down about 5% when this news broke. So coming back a little bit. But Matt, as we were talking about, you take a look over the past 5 years, this stock is down over 60%.
Yeah, it's gotten absolutely crushed. And I think it's a problem with the whole industry, but specifically JetBlue has tried and tried to turn around and failed. T-Mobile stock down right now, just less than 4% because SoftBank sold its stake to invest more money in AI opportunities. And SoftBank sold its stake at about a 3% discount to yesterday's shares, so it makes sense that they're trading down 3.8%. Of course, SoftBank still owns more of T-Mobile and could continue to unload that because they want to funnel hundreds of billions of dollars into the Stargate opportunity with OpenAI and the Trump administration. We're back here with Meredith Whitney, Advisory Group CEO Meredith Whitney herself, and you're in the sort of Washington area normally, and you're so focused on what goes on in Congress and the Senate, how that affects markets. The Senate has recently put out its draft of this one big, beautiful bill. What do you think about that? When you look at, the different incentives, we're going to talk to Scout Motors CEO Scott Keogh a little bit later. There are a lot of incentives on the table for him to make cars here, but there are a lot of, like the EV credits are going to be gone, and Section 899 could hurt Volkswagen.
Look, there's a lot of fat in the bill, either way you slice it, and that's concerning to a lot of people in the bond market. I think you've got two things going on. You've got, or three things going on. You've got real concern over the deficit. You've got real concern over the immigration policy, and you've got real concern over tariffs. And the combination doesn't look like it's going to end well. So, it's hard to imagine. So within the bill also, there's $70 billion of money to increase border security, which is fine, but also immigration raids. That's going to put upward pressure on wage inflation. And I think you're going to start to see that. And while the president has backed off on hospitality and leisure, you still got construction. That's a third of construction is employed by Latino labor. So I think there's going to be a lot of impact from that. So when I talk to my DC wonks, they're very out of fashion because they actually care about a responsible fiscal budget. And Washington, and particularly the White House, seems to have earmuffs on.
By the way, what's it like down there? Do you have dinner parties and you've got lobbyists over all the time, or do you have Congress people hanging out at your house? Or
I do. It's more of a lunch crowd, a lunch crowd. And so I was at a lunch with muckety mucks, which was terrifying in terms of the bipartisan take on where we're headed with the fiscal deficit. But again, we're not in fashion because we actually are nonpartisan and are probably nerdy and want to look at the numbers. I mean, one person that I've had the delight of spending time with recently is Paul Ryan, former Speaker of the House. And
interesting.
He is so rational, or he has solutions, but of course, out of fashion these days.
Yeah.
Let's hope he comes back soon.
Well, Meredith, I'm curious to get your take on part of the big, beautiful bill that seemed to alarm Wall Street for a couple of weeks, and that was Section 899, the so-called revenge tax. Basically, the net effect was thought that it would make U.S. assets even less appealing, that it would target individuals and companies and add a tax to those policies that the government deems discriminatory. It looks like it was watered down a little bit in the Senate version. I wonder, does that make it into the lunch party conversation?
I think that's really scary because the idea is also, could your assets be seized? There was an op-ed yesterday about talking about not paying interest on treasuries. I mean, that's terrifying, right? So that would be to banks or foreign banks. But what message does that send to the rest of the world if we are really, anti-China? While all of a sudden we say don't pay interest on Chinese ownership of treasuries? There's obviously a flight of dollars, from dollars, a diversification from dollars. There's still a heavy dollar weighting. Obviously, I don't think that's going to change anytime soon. But this doesn't make foreign investors feel any more comfortable with the U.S. market. There's no other place to go at the moment. So look, the European banks have been incredibly resilient. If you look at dollars in Hong Kong banks, they've spiked over the last 2 years, and particularly over the last 3 or 4 months. So dollar-pegged Hong Kong dollars are a safe source of diversification. Gold, obviously.
Well, you make a good point that, the U.S. has the benefit of being, on some level, the only game in town. But you talked about European banks. I want to talk about U.S. banks because I'm reading through the notes that you sent our producer, and you really expect bank consolidation. We haven't seen it yet. Maybe we'll see it in the second half or in 2026. Talk us through the logic there of that call.
Okay, so this is all centered around the juxtaposition of Michelle Bowman and Dan Tarullo. So Dan Tarullo put together a very complex double, triple check on the large banks. At the time, over $250 billion, now over $100 billion in assets. And 2/3 of those banks, the 20 there's 29 banks. We take two out of them, which they're above the 10% deposit cap. Sorry, not to get into the weeds, but that's Bank of America.
I think our viewers
on
are in the
Bloomberg
weeds.
TV, it's okay.
And JPMorgan, they shouldn't be able to make any acquisitions. But for the rest of them, 2/3 are rated unsatisfactory, which means they can't do anything. And they're not rated unsatisfactory on a capital basis. They're rated unsatisfactory on a subjective basis, either governance or management, or they're subjective, and they're only looked at once every looked at. They're technically supposed to be looked at twice a year, but they're really looked at every year or so.
But does that regulation and does that view just get loosened? Does it get just liberalized?
I think
laissez-faire.
I think it gets streamlined, and so I think you actually. She might just trash Trillo's layered rating system, and maybe just go to Camels or go to the regional banks are solely valued on the Camel rating system, the classic bank rating system, but the larger banks have multi-layered ratings, and if you do away with that or you streamline it, it's more efficient. It's probably a better regulatory environment, and you could see real consolidation. Now, the consolidation for the larger banks to acquire the medium banks, I always thought, this is going back to 2010, I always thought that you should see super regional banks created, and they're banks, let's say, between 20 and 50 billion, 15 billion and 50 billion that could consolidate, which would make a lot of sense. But I think First Horizon and TD last year really gave a chill through the banking industry. Now, the Capital One Discover, the fact that finally got approved is a good sign, but I think bankers still have PTSD.
All right, bankers still have PTSD. That's a good place to leave it. Meredith, it's always wonderful to see you.
Fantastic to have you here. I learn something every time you come on.
So nice, thank you.
So Camels is something I haven't thought about or heard in a long time. Capital adequacy, asset quality, management, earnings, liquidity, sensitivity to market risk.
There you go. Added to the list of acronyms. That was Meredith Whitney of the Whitney Advisory Group. Let's get a check right now on this market right now. We've been watching this sell-off underway in the S&P 500, down about 0.3% at the moment. Let's talk about why. You only have 90 names in the green in this index, more than 400 in the red. You take a look at what's doing well. It's energy, as we've been discussing. Up at top, you have ExxonMobil. Then you also have NVIDIA helping this rally, Chevron and AMD, as we've been talking about. Let's take a look at the downside, though. Microsoft up at top. That is your biggest weight to the downside right now. Apple, Tesla, and Eli Lilly. Eli Lilly paying $1.3 billion for Verve today. That's weighing on shares a little bit. If you break it down by the sector level as well, you can see that we only have one sector in the green today, and that is energy. Up top, up 1.3% as we continue to monitor what's going on in the Middle East. Then you go down the list right now. At the bottom, consumer staples, healthcare, and utilities. This is Open Interest. Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Roku getting upgraded to a buy over at Loop Capital after the streaming service announced an ad partnership with Amazon yesterday. Shares up marginally. Next up, we have Novavax getting initiated over at Citi with a sell rating. The firm says that there's been a decline in respiratory vaccination rates, also cites uncertainty for vaccines and healthcare policies overall. That is a sector-wide issue. Novavax down 3%. And finally, we have drug maker Sarepta getting cut over at Morgan Stanley. This is the latest downgrade from Wall Street after news that a second patient died after getting its gene therapy for a rare muscle disorder. Shares are actually up 6% right now, but it was a total wipeout yesterday, Matt Miller.
All right, so a little bit Katie, this is a dead cat bounce.
Okay, there you go.
Senate Republicans are proposing a number of changes to Medicaid. Proposed changes include cuts in programs that provide insurance to people over 65 and the disabled. It would also change how pharmacy benefit managers do business in the program. Stocks tied to that program mixed after the opening bell. Joining us with more is Bloomberg congressional reporter Eric Wasson. And Eric, I think the top line that people are interested in is how many people will lose their access to health care over the next decade because of this legislation?
We don't have an estimate on the Senate bill. It is different from the House bill. The House bill talks about 16 million people losing access. It probably would be a similar number here. It takes the Congressional Budget Office a couple of weeks to come up with the analysis. The main tweaks are, there's a work requirement now for Medicaid that doesn't exist in current law. It's a little bit softened in the Senate bill. Those parents with kids 14 and under can be exempted. There's more of a phase-in for states. But on the other hand, there's something known as the Medicaid provider tax, whereby states will bill providers like hospitals and then get a higher reimbursement from the federal government. It's a bit of a gimmick, but it's one that many, many states have come to rely on. That's now capped at 3.5% eventually in the Senate bill, as opposed to a 6% future cap in the House bill. It's much more stringent. This is to find more savings, more, less of an impact to the deficit. And it's already raising big objections from some Senate Republicans like Josh Hawley, who said he was flabbergasted by this change and may oppose the bill over it. So this is going to be a big debate. One thing that was interesting, you see Humana up there, there was talk of a Medicare Advantage changes, a sort of upcoding in that program whereby insurers bill for a more expensive procedure than patients actually got. That's not in the bill. So when we report it could be in the bill, those stocks move lower, and we may see them moving higher now because those Medicare pieces are out.
Yeah, appreciate that call out there. Something to watch. I do want to talk about what's going on with solar stocks right now, because you look at the biggest losers in the S&P 500. It's the likes of Enphase Energy, First Solar as well. You can see Solar Edge and Sunrun down.
These are one-day moves?
Yeah, Sunrun down a whopping 43%, Eric. And my understanding is that basically the Senate Republicans have proposed a full phase out of tax credits for wind and solar energy by 2028. And I guess these moves speak for themselves.
Yeah, wind and solar really get whacked. Other forms of renewable energy, whether it's geothermal or hydrogen, there's a longer phase out. Nuclear was already getting more generous treatment due to lobbying by certain senators. So this is going to be continuously negotiated up until a possible Senate vote next week. But yes, certainly wind and solar are big losers. I also want to point out pass-through businesses. They were getting a 23% qualified business deduction in the House bill. That's down to 20%. A lot of these owner-operated businesses already say they're unfairly taxed because they pay through the individual code, which can pay up to 37% as opposed to corporations with 21%. So there's big changes there. Tipped workers and overtime workers, there's new caps on that in the Senate bill to sort of save money, so you're not able to expense huge amounts of tips there. So there's some big changes. It's going to be negotiated. We have a story coming out later about the challenges. There's certainly some doubt that the Senate can pass this by July 4th. Ron Johnson was on our rival network talking about delaying it till August. So there's a lot of moving parts here, and a lot of industries affected, as you pointed out.
All right, Eric, I'll just say, if this comes with the SALT cap, there's a lot of congressmen here and congresswomen New York who aren't getting reelected. Eric Wasson there, a congressional reporter coming to us from Capitol Hill. Coming up, JetBlue is planning more cost cuts as travel demand softens. The stock only down 3.4%, but as Katie's pointed out, it has already taken a huge hit. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks just 21 minutes into the session. We're looking at moves lower, but they're fairly subdued. S&P 500 now down 0.4%, still holding over 6,000. The NASDAQ down a little bit more, about 0.5% right now. Take a look at some of the movers, and we'll show you why we have these moves. NVIDIA down not by much, but it's a $2.5 trillion, $3 trillion stock, as is Apple. So when these stocks move lower, they really take the market, or at least the benchmark indexes, with them. JPMorgan Chase down, even though you've got that story on Sapphire. It's different. It's a different story, really, than what's moving the shares. American Express also getting into the credit card wars. Maybe investors see that as a little bit bearish for those companies. And then American Airlines and Jetblue, both down. Jetblue CEO on CNBC this morning saying they're going to cut back on costs, which have already been cut and cut and cut and cut and cut. They're going to reduce investment in personnel. They're going to reduce investment in their fleet, and they're going to leave some of their airliners parked, which is just not what you want to hear if you're an investor in this company, which has tried to turn around again and again, Katie.
Well, let's talk about it more now with Sid Phillip. He is Bloomberg's chief global aviation correspondent. So, Sid, some of these cost measures include eliminating some flights, pausing retrofits, also parking some jets, and the CEO blamed basically weaker travel demand. Sid, how much of this can we blame on industry-wide issues versus things that are specific to JetBlue and the management team?
Thanks, Katie. So, yeah, JetBlue has been struggling more than the rest of the industry. And I mean, the big four in the US, the big three really, Delta, United, and to some extent American Airlines, haven't seen as much of a slowdown in travel demand as the others. But there is some pressure in the US in terms of travel demand, especially as they go into the very lucrative, very important summer months. And that's really when airlines tend to make most of their money. And so this is a really bad sign for the airline that they need to cut flights, they need to eliminate some services, park some jets, stop retrofitting planes. And that's sort of a worrying sign for the industry in general, but more so than JetBlue.
Yeah, I mean, is it correct, Sid, to think that, especially at this end of the offering, the cheaper, more affordable tickets, consumers are just going to pick whatever costs the least. So this isn't necessarily only a JetBlue problem. Maybe, their routes have something to do with it, but it's really an industry issue.
It is an industry-wide issue, and I mean, the larger carriers, what they've been doing is they've been cutting fares to fill up planes, and that's really that's basically encroaching on the turf of where these ultra low-cost and low-cost carriers have typically played. And so when the Deltas and the Uniteds come for your lunch, that's when the airlines like JetBlue and others really feel the pain of that.
And Sid, I saw in the locator that it looks like you're still in Paris. Of course, you were there for the Paris Air Show. And at the tail end of it, tell us what the takeaway was. From my reading, it looks like Airbus had a pretty good showing.
Katie, Airbus had a very good showing. I mean, they announced an order today for 100 planes from Vietjet. They announced some orders from Poland's LOT Airlines yesterday. They also announced some deals with Saudi Arabia. So they've had a really good showing at this show. Boeing, not so much. Boeing sort of taken a more low-key approach, especially after that Air India plane crash that just happened just days before the air show was to begin. And so Boeing's intentionally been taking a much lower-key approach. Their CEO and the CEO of their commercial aircraft division, who was meant to come for the show, did not come to the show. And so that's really where things are at the show.
All right, Sid, great to have you on the program. We look forward to having you back when you get home. Bloomberg Sid Phillip covers airlines for us. Katie, we have a headline crossing the terminal that the Trump administration is considering a crackdown on pharmacy ads. Here you see the pharma stocks, which I believe were already down.
Yeah.
It's really going to be the advertisers that this hurts the most.
True. If you do, take your microscope out and look, you can see a little bit of a spike down when you look at Merck and Pfizer intraday. But you're right that this not great for the advertisers. Interpublic and Omnicom shares falling to session lows on this. So there you go. And that headline, once again, the Trump administration said to consider a crackdown on pharma ads. We'll continue to follow that one. Coming up in the next hour, Nassim Taleb of Universa Investments shares a spicy take about banks losing popularity, and we'll ask him as well why Wall Street is moving south. He's the star of tonight's debut of Sonali Basak's new show, Bullish. This is Open Interest. We are 30 minutes into the trading day and looking at a market that is, ebbing as it
flowed yesterday.
Yeah, it certainly is. You're not seeing the same risk premium in all asset classes. The haven bid back into the bond market just a little bit, but oil certainly showing that risk premium once again.
Welcome to Back to Open Interest. I'm Matt Miller.
I'm Sonali Basak, and today we were looking, of course, at what is happening. President Trump leaves the G7 early to deal with the Israel-Iran conflict, and he says he wants a real end, not a ceasefire.
Retail sales fall for a second straight month, suggesting consumers are feeling at least a little bit of anxiety, possibly driven by tariffs.
Plus, tonight, the premiere of my new Bloomberg original show, Bullish, an immersive journey through the high-stakes world of finance, as seen by its titans and its rising stars. The first episode airs tonight at 6 p.m. Eastern Time on Bloomberg Television, and it's all about Wall Street's shift south. And joining us now for an exclusive conversation is one of the people featured in the episode, Nassim Taleb, famed quant trader, author of The Black Swan, and senior scientific advisor to Universa Investments, of course, based in Miami.
Hi.
It's an interesting time. Matt and I have been joking. It's been a tough year to launch a show named Bullish, except for we're back in a bull market.
Yep.
And strangely enough, Universa, known for tail risk,
Yeah.
is also bullish of late for the last couple of years.
No, Universa, let me separate. Universa is not bullish on the market. Mark is bullish on the market.
The founder.
The Universa does not express opinion about the market. There is a strategy of tail hedging to try to allow people to have more stocks or more something else, but it's not reflected in the opinion. You
So
see
he's
that,
bullish,
so
but the investments are not necessarily.
it's not, no, there's absolutely zero impact on the opinion on the strategy. So like your insurance company is going to be an insurance company, okay, day and night. They're not going to lower or to change their parameter. It doesn't matter. They just go by a strategy.
So where do we go from
yes.
here? Because this has been a choppy year. But
It
is the
has been a
worst
choppy year.
over in terms of the risk priced into the markets, given all that we're seeing, geopolitical risk, risks tied to the fiscal situation in the U.S.?
This is the environment where one
Needs to buy insurance.
justify a tail hedge because of the uncertainty rather than a direction. But and of course it did work out this time, as it does work out, almost always. But it did work out, compared to other approaches to hedging that either failed or didn't perform well.
You became a household name, essentially, at least in Bloomberg viewing households,
Yes.
when you wrote The Black Swan.
Yeah.
And I wonder if now that we're all thinking about that after you sort of unveiled it,
Yeah.
if it's less of a threat, because we're all looking for the unknowns.
No, actually, what has happened is it's more complex. It started with fooled by randomness, where people don't understand the difference between noise and signal, and mistake very often noise for signal. Things have gotten worse.
Yeah.
Okay. The understanding of tail events has gotten worse. Okay. The pricing of tail events, one would think would be more rational, has gotten worse. Okay. People still use bad models more and more.
Wow.
And so it is interesting. I saw that over a 25-year, the life of my book collection, the Inserto, the first one being Fooled by Randomness. So I don't think that there is consciousness of risk that has improved. We just think that at any point in time that we live in a more risky period than our ancestors or that we did before, but it's just a normal perception.
So it's interesting. A couple of years ago, Mark Spitznagel over at
Yes.
Universa warned that this was a tinderbox time bomb of a situation with the U.S. debt
Yes.
load, and that certainly has gotten worse. But the markets have been pretty
Yes.
complacent
Okay.
to it.
So
Is this
let's
time different?
Yeah. Let's look at markets. Okay. Markets are not driven by long-term economic stuff. It's driven by allocations. Okay, for example, people think that the market reflects today the impact of the tariffs and these policies that may or may not be rational. No, markets are driven by certain allocation parameters, and people, of course, panic sometimes, but they got to satisfy these. In the long run, of course, the economy will decide, and we have severe problems. The first one being the accumulated deficit. And it's snowballing, as you know, and with interest rates here, it is adding every year to the budget, so just to stay in the same place. Plus, what has happened with a lot of modern economies is that as you get richer, you see, it's normal that your growth rate would slow down because you have fewer people in poverty in your economy. You have to import, actually, poverty from elsewhere. Okay, it's like an S-curve, like a natural S-curve that we see in nature. At the top of the S-curve is when people borrow, when their growth potential is much lower, and for natural reasons. It's not nothing to do with policies. So we should be borrowing less now that we have reached, sort of like almost reached destination, because it's what we call a decreasing growth rate. And which is normal, whereas countries in Africa and Asia are far away from that point. You see, they still have people in poverty that they got to pull up, and that will increase their GDP. And they can borrow, but they're not the ones borrowing.
Right. But we're not going to be borrowing less. I mean, clearly, we're going to continue to increase deficits, at least if this one big, beautiful bill is passed. And I wonder about the products that Universa sells, right? Yeah. You can hedge against the kind of tail risk, like if the U.S. defaults on treasuries, right? We see a drop.
We are focused on the stock market. We just use that as a driver. Okay?
Right.
So because you're targeting one variable. You're not targeting events because events are not well defined, but that variable is very well defined.
Well, I'm just saying that this is an event, a default that would trigger, an instantaneous drop. But it's harder to hedge against something like the slowing decline of the dollar.
Yeah, but okay, so that is but that would end up being reflected in stocks, the slow decline of the dollar, and effectively the second risk. So the first one is the deficit. The second one is effectively that the dollar is losing its status as a reserve currency.
What proof do you have of that, though?
You can see the accumulation of gold in the reserves and the behavior of gold over the past 12 months. And it didn't start with Trump's policies. Of course, it started with Biden when he froze the accounts of people connected to Putin.
Right.
And of course, thinking that it'd be limited there, but people not connected to Putin, decided to stay away from a euro and a dollar. And gold is effectively now the reserve currency. So transactions take place in dollars, euros, usually dollars, and at the same rate. However, they get converted back into gold. And we can see it from the accumulation of reserves.
You know, it's interesting. Citigroup just this morning said the gold rally might hit a timeout this year. They said that it could start to retreat after running to near record highs.
What do they know? How do they know? How do they know?
Well, that's my question to you. If you were afraid of where the U.S. deficit is, if you were concerned about the dollar, and at this point geopolitical risk, are you stockpiling gold? Even at this level?
Okay, I'm not a central bank, so, I think that with what's going on now, particularly with the new administration, the perception of America is the riskiness of America has increased. So on top of that move into gold that started with Biden, we have now a move into gold by people who are afraid of these policies, and
including central banks around the world, which doesn't look like it's going to let up.
Especially central banks around the world. So the dollar is a good transactional currency because people can label things in it, but not necessarily a storage currency. And this is what we're facing now.
All right, we're going to keep you, Nassim, we're going to keep you with us. Mm-hmm. I want to just quickly mention again to our viewers that we've had news breaking in the last 15 minutes. The Trump administration is discussing policies that are going to make it harder and more expensive for pharmaceutical companies to advertise directly to patients. As a result, we see pharma stocks moving down, or as a result, they moved lower. They were already moving to the downside. But more interestingly, I think, is the advertising giants such as Interpublic and Omnicom taking a hit, moving down more significantly and to session lows. But most importantly, to me, the message I really want to get across to viewers is that you can check out the first episode of Sonali's new show tonight.
Thank you so very much. We're looking forward to showing it to you. You can already catch some of it on the Bloomberg terminal, but catch it tonight on 6 p.m. on Bloomberg Television, featuring Nassim Taleb, Ken Griffin of Citadel, and more.
You know what's wonderful about being in Miami? You go to dinner and you talk with your friends about the future. And the optimism here is infectious. Is the American dream still alive? It's alive and kicking here in Miami because people here in Miami believe that tomorrow will be a better day. So it's really great to be here in a city that just exudes the belief that in America, anything can happen. And Americans who believe that make things happen.
Let's get to high interest now. Look at what's making headlines around the world. Elon Musk's artificial intelligence startup, xAI, is in talks to raise $4.3 billion through an equity investment. That's on top of the $5 billion it has recently been trying to borrow from debt investors. The company needs the new money in part because it has already spent most of the $14 billion it previously raised. Huge fundraising rounds have become a standard feature of the fiercely competitive AI industry. Just think of the SoftBank story we were telling you earlier. Big Pharma is lower after news that the Trump administration is discussing policies that would make it harder and more expensive for pharmaceutical companies to advertise directly to patients. Such a move would disrupt the more than $10 billion in annual advertising that pharma companies buy. Limiting those ads would be a major win for Health and Human Services Secretary Robert F. Kennedy Jr., who says he believes Americans consume more drugs than people in other countries because of direct-to-consumer advertising. It would be a huge lose for the advertising companies, which is why their shares are the ones that are actually moving on this news today. And JPMorgan is unveiling an update to its Sapphire Reserve credit card. The premium card will now carry a nearly $800 annual fee. It's a 45% jump from its previous level and the card issuer's largest price increase for the Sapphire since it launched in 2016. Lenders have been locked in a fierce rewards battle to lure affluent customers for years. Yesterday, American Express announced that it is making its largest investment ever in a refresh of its own travel-focused platinum card. Sonali?
Fascinating. That all for customers. Now, as you've been talking about, Matt, thank you very much. My new Bloomberg original show, Bullish, premieres tonight at 6 p.m. Eastern. In the first episode, I sat down with Nassim Taleb of Universa Investments and asked about the future of the banks.
Nobody cares about banks except bankers. Because bankers used to lend, used to take deposits. Now people manage their own deposits with zero interest rates. And so the market got a little smarter by moving deposits away from bankers. And loans, were securitized. So hedge funds have much more variety.
Nassim Taleb is still here with us on set, and it's so interesting. 6 months later, just over the last 24 hours, we're hearing that Millennium, for example, is one of the firms that is looking to sell a stake at a $14 billion valuation. These massive multi-strats and non-banks have been much bigger in the market. Do you ever worry about systemic risk with the way things are going?
Much less with hedge funds, and I kept advocating for the transfer of risk from banks to hedge funds because hedge funds don't have the skin in the game problem. Okay, bankers, of course, they have very little to lose, and they're prone to bailouts. On top of that, hedge funders have their money in it, so I think the risk management is much more rational with hedge fund than it has been with banks. Banks, they use just models to cover their reputation and nothing else.
What do you think, though, about the opacity of private markets, especially as they continue to grow? I mean, they're bulging, right? Everybody's racing to put money into private credit, and it has been for years, and yet it doesn't. There's no Carson Block looking at these.
Okay, if there's no bailout potential, then opacity isn't harmful. You see, because those punished will be those who put money in it. That's the functioning of a normal functioning of a market. However, if there's a potential bailout, then we need to know well, we may have to bail out. You see, so this is where I would look more into the details of what we are insuring as taxpayers, what we are insuring.
But so Nassim, that's better off bank, right? That's better in the shadow banking system. If it comes to a bank branch near you, then it's a problem.
But the banks are lending more to the non-banks. That's the problem.
Banks became utilities progressively. After 2009, 2008, 2009, after that period, people understood that they should not be taking risks, and progressively, money went where it should go.
You know, it's interesting. The hedge fund industry, by and large, throughout the course of this year, we've been talking about it a lot. They've done okay. Actually, everybody has held up through the course of all of this volatility. My question to you, you were talking about the big risks that the U.S. is posing.
Yeah.
What about the Trump administration's strategy? Is there more volatility ahead?
So, let me tell you, long term, this is why I think that we need to worry, maybe not about the stock market. It may express itself elsewhere. We need to worry because the approach is not very rational. First of all, they're amateurs doing numbers to start with. The other thing is when we have 4% unemployment, think about it, you have 4% unemployment. It means the economy. What are you going to do now with these tariffs? Try to shift business from high added value into low added value? This is what we're invited to do? Well, that will depress GDP. So in other words, it's like asking a surgeon, just for balance, to clean the streets one day a week, okay? So of course, it would depress GDP. That's exactly what the Trump administration is getting us to do. I understand tariffs. Tariffs may be necessary in many areas. Tariffs need to be symmetric and stuff like that. So this we understand. But the way they're going about it makes no sense.
Can you understand, the reasoning behind it? Because these are people, that Trump has around him. Scott Bessent, Howard Lutnick, Stephen Miller, who they're not idiots, right? They've done well in their careers. They went to Ivy League schools. Like, why are they doing this?
There's a difference between, they're not idiot and they're not specialists in that area.
Right.
And they're probably okay in what they've done in the past, although
Peter
I'm not
Navarro.
sure about all of them. Yeah. Peter Navarro, I apologize, but I'll have to say that in his own domain, he hasn't fared well. Okay, the other ones had some kind of performance in an area that is orthogonal, in other words, uncorrelated to the current performance. It's like asking a dentist to do brain surgery. Okay, it may do better than average. I'm not sure. Okay, so none of them really is a specialist of the area that they're discussing. And this is where I find myself agreeing with economists. Okay, that basically it makes no sense, and the approach is irrational. You see, the idea of confronting China is irrational. But now let's think about what are going to be the effect. Well, there are two things they're doing. The first one, tariffs on things that we don't produce. It's going to tax not the middle class, but it's going to class
the poorest among us.
The poor, because
it's regressive.
And then compensating that with a tax break doesn't work if you don't pay taxes.
Well, my question too is, you have the Treasury Secretary saying that, maybe artificial intelligence will make this economy more productive. Do you buy that?
Maybe we can wait.
More jobs.
Yeah, maybe for Christmas we'll get Santa Claus coming in and distributing money. A lot of things can happen with maybe. You see, as the French would say, with maybe you can put Paris in a bottle, right? So the idea of these the tariffs may be sound. The way they're going about it is it's like trying to wreck the boat voluntarily. That's the first one, is tariffs. The second one is immigration. I don't know if you realize the structure of American businesses and American labor. Last time we had a labor shortage, we saw what prices did, okay? People have large loans. Everything is based on cheap labor, okay, coming from Latin America or elsewhere. Everything's based on it. So trying to constrain that source of labor may make sense in the long run, but like in Japan, for example, they have small houses. Here, people have mansions. Okay, you won't be able to find people to mow the lawn or do things. And then if you have to wait for artificial intelligence, okay, let me know when it comes and revise my opinion. For the time being, we don't have cheap robots.
Yep.
So there's a lot of dangers in these policies because it's not that they didn't think of the second order effects.
We have to leave it here, but we hope to have you back soon to talk about the second order effects. It will take a long time to play out. That is Nassim Taleb of Universa Investments, and we thank you for joining us, and of course for joining us for Bullish too, which premieres tonight at 6 p.m. Eastern on Bloomberg Television and 8 p.m. Eastern on Bloomberg Originals.
I'm going to watch it on Amazon Prime.
Yes, it will be on Prime Video as well on the Bloomberg feed. We are looking forward to expanding the Bullish empire.
This is Bloomberg. Coming up, automakers grow concerned over the potential elimination of EV tax credits. We're going to speak to Scott Keogh, Scout Motors president and CEO next. This is Open Interest. The Senate draft of President Trump's big, beautiful bill provides 100% bonus depreciation on plant and equipment, domestic R&D expensing, and will allow the deduction of interest on loans for vehicles assembled here in these United States. But will those incentives outweigh the elimination of EV tax credits and the threat of Section 899, the so-called revenge tax on foreigners, so important to EV makers like Scout Motors, which is owned by Germany's Volkswagen? Joining us now to talk about that is Scott Keogh. He is Scout Motors president and CEO, and we're all, I think, car people are all
we all are great
waiting to see this vehicle drop and get behind the wheel. These incentives we don't really talk about as much as we do the EV tax credit. So how much is that helpful to you?
Look, it's hugely helpful. I think if you look at the very premise of Scout was to do exactly what's happening in America. Bring back an American icon, invest in America, locally sourced in America, and of course our factories in South Carolina. So there's a lot of drama and noise about, let's say, the consumer tax credits, and of course that's an important thing, but there's a lot of opportunity. From the depreciation, we're making heavy investments in equipment down at the plant right now, so I think there's a lot of opportunity, and we like our position, frankly.
Well, what's the math look like, and how does it change based on how the policy changes?
Look, I think the math doesn't change, and the math is, number one, you need to get the material cost down on the car, and that's something we've been able to do very well. I think the struggle of startup companies is they don't have good deals with suppliers. They don't have good material costs, so we've gotten that right. To me, the big three is, do you have great tech in your car? Do you have a good cost basis? And is the brand going to be a differentiator? And we have those things, and we feel good about it. With regard to the math, look, the consumer tax credits were always going away, so there's no way you could live off of that. I think they were going to be gone by 2032. The other thing I think of, it's naive to anchor everything you have on government policy so government policy can move. Make a great truck at a great price that people love, and that'll put you in a good position. And that's what we've always wanted to do.
And don't depend on one powertrain. To me, the exciting thing is you're going to be able to choose an EV, I think, able to choose a hybrid powertrain with a gas motor. So you're going to be competing against not only the Rivian, but also the Bronco. What kind of variants can I expect? What should I be dreaming of?
You've nailed the point. So I think the first thing we wanted to do is have a platform that could handle these dual drivetrains. More importantly, have that platform be executed in the factory. I think, as you know, people are ripping up their factories each and every day when technology changes. We've designed it from the get-go to handle both. So yes, you'll have exactly that. You'll have a pure EV, and then of course you'll have a really awesome range extender. What does that look like? 150 miles of EV range, 500 miles of total range, 0 to 60 in under 4 seconds, 1,000 pound-feet of torque, maximum gradability. It's really a go-anywhere American vehicle, so it's awesome.
Can you?
What else do you want to know? We're here.
Off-road. Well, I want to know about the variants because, look, with the Bronco, you can get everything from a 2-door to a 4-door. You can get the Wild Track. You can get the Raptor version. You can get the Heritage version. Like, which variants am I going to be excited about, Scott?
Look, you're getting a little bit ahead of it. We're not releasing everything, but
that's why I'm asking.
As you know, of course, we have a 4-door SUV, which will be a home run. Of course, we have a pickup truck. And then we have all sorts of, let's say, outrageous derivatives that we'll deliver, but nothing we want to get into just yet. Right now, we're building the factory. We're starting a team.
Maybe
we're doing all these great
things. You can
things.
tell me after, off the record.
I am curious about
It'll be
the
fast
factory.
and fun. I'll guarantee you that.
you know, for those who don't remember, South Carolina is the home state of Scott Bessent. It is an important state for that reason, if nothing else. But also, it is a place that they want to bring more people back like you to manufacture there. I mean, what does production look like so far?
You know, I do have to give the state a lot of credit. Governor McMaster and Secretary Lightsey, they understand business. They understand how to make things work. I think the number one thing we are impressed about, a lot of states have land, and they say, here's a great site. But you have to understand you need infrastructure, you need rail, you need logistics, you need power, you need water. The state understands that. What does the site look like now? Well, it looks like a construction site. 1,600 acres, 1,100 acres under development. We have nearly 3 million square feet enclosed, so all the buildings are fully enclosed. The next step, of course, is the equipment is going to be coming in, the depreciated equipment that, of course, Matt referenced. And, of course, then we're going to start to hire the workforce in the coming months. So it's really ramping up. The government is doing a great job on the infrastructure. An overpass is putting in, a rail hub is being put in. So it's all happening. It's quite dynamic, and it's a cool thing to see.
In terms of the workforce, you have Spartanburg down there as well. So BMW has, I think, primed a workforce for you.
Yeah.
Is that not a concern, labor? Are you going to readily get that?
Look, I think in America, you always have to be concerned about labor. I think we all know 4% unemployment nationally. In South Carolina, it's actually even lower. What I like about the state, as you said, BMW's up in the hills there in Spartanburg, and of course in Charleston, there's manufacturing. We have our own area in the Midlands, so we can be the top provider in town, 100%. So we can set the benchmark, we can set the flag. There's nothing that is quite like this. So I think the other thing we need to do is need to do our jobs. We need to pay people well, we need to train them well, we need to treat them with respect. The training center is being built. And the big thing here is you don't have some here today, gone tomorrow job. There's a lot of people in agriculture, in service, no benefits. We can offer real jobs.
I got to ask about the supply chain because RJ Scaringe and Rivian learned a very important lesson when they launched and all of a sudden couldn't get access to the chips they needed, right? And they have never been able to get production up over 50,000 a year. Magnets are the problem now. Maybe it's not as bad as chips, or is it?
Look, I think first thing about the supply chain, I think it's a very good thing to have the backing of the Volkswagen Group. So, for example, if we go to a supplier as Scout Motors, as a startup where we don't know where our funding is coming from, and we say we need 50,000 seats, that's a whole different conversation than we say we're buying 10 million seats. And so we can get much better terms of trade, which I think is fantastic. The other thing is we always intended to locally source. So we'll have about 50% of our supply base will be in 200 miles of the factory. So insourcing was always the case to get it done here in America.
But you can't get rare earths in America. That's the problem. You're not going to be able to. So
that's fair. I think with rare earths, the big thing there to look out for is you can make some engineering decisions where you use less rare earths, full stop, and that's something we want to do. I think the good news, we've identified the problem. You know the answer. America's capable of doing it. We have the minerals. We have the mining. Is it an ugly business, and is it environmentally not ideal business? Yes, but we're capable of doing it. I think the good news for us, we can see transparently that it's an issue and we can navigate it. And we have some good answers on brakes, some good answers on drive units where you use less rare earths. It can be done, and that's how we're engineering the vehicle.
Excellent.
Scott, come back to us when you have that fixed. That is Scott Keough.
You have to come down to Carolina and see the plant, but we will.
I definitely will be down there.
Drive fast. I'm a little afraid. That is Scott Keough of Scout Motors. We appreciate you here joining us here on set. Let's get a check on these markets because it is a tough tape out there. We are off the session lows. We are still down about 0.3% on the S&P 500. A little more so on the NASDAQ 100. Interesting, the 10-year hanging out around 442. Kind of steady as she goes relative to the last couple of days.
Yeah, I mean, we've seen some ebbing and flowing, but look, we're hanging out at 6,000. We're still 2% away from an all-time high on the S&P 500. It looks pretty good, certainly not nearly as bad as it did in the middle of April.
Nobody in the danger zone today, but of course there's a lot of risk under the surface. And of course, a big Fed meeting. We're going to talk about that more with private investment firm Kayne Anderson, which is closing its second real estate debt fund. Interesting time to invest. Al Rabil, Kayne Anderson CEO, joins us next in a Bloomberg exclusive. This is Bloomberg Open Interest. Now investors will be searching for clues tomorrow on the Fed's rate path tomorrow afternoon, and Bloomberg Economics expects the Fed to signal that they will cut one time in 2025, while the market is pricing in just under 2 cuts. And among those paying attention will be major players in the real estate industry and private capital too. Rates matter. Joining us now, Al Rabil, Kayne Anderson, CEO. And do you think that at least a cut gets done in this environment? There's still a lot of concern about the administration's tariff policy and what that could mean for inflation, where oil prices have been heading. How do you feel?
I think we're going to see 2 cuts this year. I know Bloomberg said 1. Whether it's 1 to 3, I think directionally we're going to a lower interest rate environment. We have not seen, stating the obvious, the full impact of tariffs at this point. We are in a slowing economy. I mean, we've got consumer debt at all-time highs. We've got delinquencies rising. So you've got all of the telltale signs. So this may be the calm before the storm. I think it's interesting. I've said for a long time, and maybe a clock is right, twice a day. A broken clock is right twice a day. But I've said for a long time, I think that investors are underpricing risk. So the VIX at under 20, given what's going on globally, geopolitically, interest rates, tariffs, et cetera. There's just a lot of uncertainty out there. And I think
you're in good company. Yeah. Nassim Taleb just said the same thing. Of course, he's kind of talking his own book. They're obviously
the Black Swan.
Literally the book and Universa. What can you divine from the real estate environment? I mean, from housing starts, from mortgage apps, from, the whole picture in the U.S. What can you divine about the consumer from that?
Well, I think let's talk about multifamily housing and supply. You have a dearth of supply in this country that's not getting any better with cost dynamics. So I think what you're going to have is a demand-supply imbalance for many, many years that is going to lead to rent increases. You're seeing unaffordability of homes. I think that will be addressed. I think home prices have to come down. Real estate is such a broad category.
Right,
I think
it's still the opposite of what you're seeing in office, right? I mean,
correct.
If only you could just convert office to residential.
Which is a very difficult process, not happening in a lot of places, not happening quickly. So I think office
not
is
on the 3rd Avenue corridor here.
No. I think you're in a 5 to 7 year repositioning dynamic for office. I think I've said this before to you, Matt. I've been in this business long enough to know that forever lasts for 5 years. So I don't think that we have the death of office globally or in this country, but I do think that it's not going to change very quickly.
Now, we understand also that Kayne has raised more money above target. It's a hard fundraising environment, so very impressive to bring in so many dollars, 1.7.
A lot of money, yeah.
A lot of money, 1.7 billion in commitments for opportunistic real estate. Now, when people say opportunistic, you tend to see values, right? So what are you seeing in terms of drop-offs in prices in real estate that are worth picking at now?
So to be clear, that is an opportunistic debt fund. And it's the second opportunistic debt fund that we've raised. The first was in March of 2020. And we invested the vast majority of close to $2 billion.
Is this 2020 type?
It's not 2020, but you have to be prepared. And I think at some point in the next 2 years, we go outside of 2 standard deviations and you see some very opportunistic acquisition or equity investment opportunities on the debt side of the equation. So this isn't meant to be steady state. Let's invest $50 million a month for the next 18 months. This is something happens, there's a catalyst, there's true fear, the stock market drops 15%. People say, oh, there are $1.5 trillion of CRE that comes due in the next 18 months. There's limited liquidity, and you get maybe just short of panic. And I think we were close to getting there about a month ago, maybe 6 weeks ago. And then we had sort of tariff relief and the taco trade, et cetera.
But Al, for all the talk of uncertainty, it sounds like this isn't necessarily if, but more like when, right?
We think it's a when. The reality is, unless you're prepared to take advantage of what I've just described,
you have to be ready.
Very quickly, you have to be ready because history shows us the deep downturn typically is, if you look at 2020 as an example, that was the large opportunity was 2 weeks. So if you weren't ready to go, you missed it.
It comes quick. Now, the other thing, we asked about the short end, but what about the long end? Because really that impacts a lot more things like real estate, and you have seen a lot of muddiness in terms of where rates are headed. It's been higher for longer. Would you buy into the long end? Where do you think it goes?
I think directionally we're going to a lower interest rate environment. So I think that's short end and longer end.
Even the 10-year with the fiscal situation?
Even the 10-year with the fiscal situation. And, you know, if you look back, history may not repeat itself, but it rhymes. And if you look back for 50 years, what percentage of GDP are we utilizing to fund debt? So I'm not in the camp that we are in an irreversible situation nationally, and the dollar will continue to be the reserve currency. So I think we're going lower from an interest rate perspective, short end and long end. But I think the long end will be a little stickier.
The danger zone that we always talk about is like, I guess 4.7 is now on the 10-year.
5% people are getting really worried about too.
Where does it start to become, time to actually do something?
Listen, I think when you approach 5, that starts to get into danger territory. I mean, we're squarely below 4.5 today.
Yeah, it feels easy right now to me.
It feels easy right now, and there may be, a little bit of, as I said, I think there's a little bit of investors underappreciating risks, which isn't predicting some calamitous event, but I do think that the next 18 months there is going to be a lot of uncertainty, and uncertainty presents opportunities for those who are prepared to take advantage of them.
The message I'm hearing is buckle up.
Yeah.
Al, we thank you so very much. That is Al Rabil of Kayne Anderson, of course, the CEO. And coming up, President Trump leaves the G7 early to seek what he calls a real end to the conflict between Iran and Israel. We're going to discuss what that could mean next. This is Bloomberg Open Interest.
President Trump is downplaying the prospect of a ceasefire between Israel and Iran in favor of what he calls a real end to the conflict. Mark Champion, in his latest Bloomberg opinion piece, says it is difficult to end rather than just delay Iran's nuclear weapons ambitions by war alone. Indeed, that could even accelerate Iran's acquisition of a bomb. Mark Champion joins us now, Bloomberg opinion columnist covering the Middle East. And Mark, the president put out a Truth post saying essentially that all citizens or people in Tehran should evacuate. He's previously said something about turning the country to dust. Why is it that if Israel completely eviscerates Iran's nuclear facilities, you think that could accelerate their chances of getting a bomb?
Well, so the first thing is, that you said completely eviscerate. What Israel has done to date, I mean, it's an extraordinarily effective military campaign, extraordinarily successful, as you by now would expect from Israel. However, what they have done is to destroy what we knew they could destroy, which is the overground facilities that the Iranians have. They've also tried to go after some scientists, which gets to the kind of core of the problem, which is, they really need the U.S. and its very large bunker-busting bombs to be able to go after the underground facilities. And B, even if that was to happen and were successful, it remains no guarantee that they can't restart their program. They have been doing this for a couple of decades now. They've invested enormously. They have the knowledge, the experience, etc. So, it is, you can argue as to whether it's sensible to delay the program in this way and whether that's to Israel's interests. And obviously, Israel believes that it is. All I was trying to point out is that if there's an end game here that's missing for the moment, it may be that the Israelis are successful on their own in destroying the entire program. So far, that hasn't happened, the general expectation, the consensus is that it would require the U.S.
So that does give a state of where Iran is today. And this morning, you've also written that the scope of Israeli ambitions are unclear. Now, how do you start to outline the ultimate goal from the Israeli point of view?
Well, the Israelis, the Israelis have long wanted to do this, but they wanted to do it with the U.S. So, what they've done is to say, okay, we're going in without you, which is, extremely decisive. And they have, they're going to do what they can do. That is a great deal. They have established air superiority, which allows them to fly, the Israeli Air Force to fly with impunity across the country. And they have been striking targets. They've been killing top commanders, entire bunkers full of commanders of the Iranian command. So that, they are clearly trying to degrade Iran's capability to wage war, whether that's offensive or defensive. And they are clearly trying to destroy what they can of the nuclear program. And they have made it explicit. Prime Minister Benjamin Netanyahu has explicitly called on the Iranian people to rise up in the hope of executing regime change. Regime change is important. It is the way, without an invasion of Iran, occupation of Iran, that is the way in which you could hope for a long-lasting and, a really decisive guarantee that the nuclear program won't just restart.
Mark, really appreciate your time. We're going to have you back on, and I'll recommend to our viewers to check out your piece on the Bloomberg terminal. Type OPIN GO, and you can subscribe to Mark's columns as well as we do. Obviously, you can get them on Bloomberg.com as well. In terms of the effect that this conflict is having, we had seen the price of oil rise. It came down yesterday, and it's now back on the upswing.
Very much pointed out yesterday during this show, 24 hours ago, that a perceived de-escalation brought crude prices down below $70 for a moment. Now we're back to above 73, and lo and behold, when you look at the S&P 500, you're 0.3% lower. You actually have almost every major sector in the red. Actually, really the only sector in the green is energy because of those moves higher. You do have a safe haven bid back in the bond market as well, only to the tune of about 1.8 basis points. Now, you do see it back around 443.
I will say that gold and Bitcoin are not gaining today, but they've risen to such levels, gold at 33.50, Bitcoin at 105,000, that you can imagine some investors are taking profit off the table. Some are still bullish.
Some are still bullish. It's interesting. The financial community.
That was
nice tease.
That was supposed to get into your show tease. Some are still bullish.
Some are still bullish.
Speaking
of, tonight, my new Bloomberg original show, Bullish, immersive journey through the high-stakes world of finance, as seen by its titans and rising stars, Ken Griffin, Nassim Taleb, people who have been navigating this market. The first episode premieres at 6 p.m. Eastern on Bloomberg Television and 8 p.m. Eastern on Bloomberg Originals. And Matt, that does it for us today. Tomorrow's Fed Day.
Yeah, tomorrow's Fed Day. We are lucky enough to have John Stoltzfus on with us from Oppenheimer Management, Claudia Sahm of New Century Advisors, and Texas Capital Bancshares CEO Rob Holmes. This is Bloomberg.